Good morning and welcome to the weekly commodity market update. I'm Brownfield anchor reporter Will Robinson, joined as always by Ben Brown from the University of Missouri. And then Ben, once again, can you just give a little bit about yourself for first-time listeners?
Yeah, good morning, Will. Hope you had a good week and started your Tuesday off well. So my name is Ben Brown. I'm an extension economist here at the University of Missouri. I work primarily in commodity markets and row crop economics. Native of West Central Missouri, growing up on my family's beef cattle and crop farm. Spent 4 years at Ohio State University before getting the opportunity to come back to the state of Missouri. So happy to be here with you.
All right. Well, so hopefully today goes a little bit smoother for farmers looking at markets than it did on Sunday for Kansas City there, especially in the second half. But just looking at the last week, can you give me just a breakdown, a market recap of really what you saw?
Yep, sure can. And I was sad about the disappointed with the Chiefs game as well. I'm a Chiefs fan too, but happy for the Bengals and look forward to watching them in the Super Bowl. So across the grains complex, kind of mixed results. Relatively flat on the week for corn. March corn contract finished up 5 cents at $6.26. The new crop corn contract for December finished up 6 cents at $5.73. However, it was the soybean contract that saw significant gains on the week. The March soybean contract up 87 cents to $14.90, reaching a nearby high for the nearby contract all the way since back in July. The November new contract for soybeans was up 60 cents to $13.67. And then the components for soybean oil up 2.84 cents per pound, soybean meal up $25 per short ton. But then, as I mentioned, kind of mixed across the complex, flat for corn, up for soybeans. It was down pretty significantly for wheat. Nearby March wheat contract fell 39 cents to $7.61. And the new crop wheat contract for July fell 35 cents down to $7.60.
So what kind of adjustments have we seen to the basis in the last week?
Yeah, we continue to talk about basis just because of the changes that we see in local bids as different parts of the country react to different supply and demand signals and impact their basis. Corn basis was up 1 to 10 cents across most of the country. The Mississippi River market saw basis increase to the tune of 15 to 20 cents. So that was kind of a representative of a little bit stronger exports on the week. Soybean basis was more consistent in the southern belt from Ohio to Kansas, increasing 5 to 10 cents, while the northern plain states like Minnesota, North Dakota, and South Dakota were roughly down 5 to 15 cents across the region. So kind of a little disparity between the northern and southern belt.
All right, so really jumping in, looking at a crop by crop basis, starting with soybeans and South American weather, because South America is where really the market kind of sets its tone this time of year. What are we seeing down there? Any changes from last week?
Yeah, we continue to see large fluctuations in our markets, both here in the United States and around the globe, because they continue to be influenced by the anticipated size of the South American production. We continue to get mixed reports from different regions of the country, and that's what's led to this choppy nature, but largely an upswing, right? So it's been choppy, but largely on an upswing zigzag pattern that we've seen the last month or so. Soybean yields vary from better than last year in some parts of the country to even above trend yields for parts of northern and central Brazil, even though we saw rainfall across most of that region through December and January. I remind people that too much rain can actually be a bad thing for crop development, just because when it's raining, there's clouds and you're not getting as much sunlight to those crops. And so that is a determinant, but then it's been very dry in the southern part. And the confusion and the uncertainty around the Brazilian soybean crop has not only caused confusion for our producers, but it continues to cause confusion for Brazil producers. Many of them remember selling beans last fall or last year during their harvest period when they thought they had really good prices, only to see prices really rally after that. And so many are holding off selling their grain at the current point on anticipation of higher prices, and that's causing local elevators there to work harder to bring beans in. So as we think about not only the pressure that we have on prices from yield decreases in South America and the potential for less acreage to be harvested, we've also got some farmer behavioral characteristics that are starting to play into the market as well.
Just looking at the lowering production, obviously that's putting some upward pressure potentially into the market there. But another wild card that we talked about before is the currency and the issues that Brazil might be seeing there, and really what kind of uncertainty does that add into the market?
Yeah, you raise a good question, Will, and I think sometimes we take for granted here in the United States how lucky we are with some of the stability that we have in different aspects of our production and really even management. And that's not to say that those concerns don't exist for the U.S. producers, but in relative terms, Brazilian producers not only have to worry about the infrastructure challenges that they face of getting their crops to the port, but they also have to worry about macroeconomic factors like currency swings or currency devaluations of their Brazilian real. If you're a producer and you're concerned about that devaluation of that currency, which it has devalued, when I was in Brazil as a study abroad student a couple of years back, the exchange rate was 3 Brazilian reals to $1 US. Today, that exchange rate sits more like 5 Brazilian reals to $1 US. And so it costs more money to buy the same product you did, even taking into account that's on top of inflationary pressures that everybody around the globe is facing. So if you're a Brazilian producer, you're sitting there and saying, I could either keep my product in my hands, the physical asset, whether that's corn or soybeans, and I can keep that product in my hand, and it largely controls for these currency devaluations, versus selling the crop, taking the money and putting it in the bank and watching my money just slowly lose buying power, right? That's another factor that Brazilian producers have to worry about. And given some of this, given the large devaluation in the Brazilian currency relative to the US dollar as a result of the pandemic, many Brazilian producers are also, that's another factor for them holding their grain longer in the season and causing elevators and basis bids in Brazil to increase. And we've seen a sizable increase where now basis bids within Brazil and the price of loading soybeans at the port is higher than what you could buy here in the United States, which is uncommon for this time of the year.
So China's been an active buyer buying soybeans. What kind of hitch does that throw into the global market there?
So I do think China has stepped in and is buying some insurance soybeans at this point. This is something that I think fits into the conversation we just had about South American weather and the soybean price differences between the United States and Brazil. This is typically a point where Brazil is the most competitive soybean on the market, and so China is actively buying from that source. Given that switch to where now the United States has a cheaper bean, getting soybeans to the Chinese market, I think that's got even Brazil or Chinese buyers thinking about buying insurance product or an insurance against a short Brazilian crop if that were to materialize. Largely, what we've seen the Brazilians buy in recent daily sales has been new crop soybeans, or so soybeans for the 2022-2023 marketing year. And so if we take what we know they've bought in the last week plus a couple of days, maybe they've bought in 7 million bushels of 2021, 2022 US soybeans. So that's our current marketing year. But they've bought almost 20 million bushels of new crop, that 2022, 2023. And so that tells me that those are being put on the book as protection of making sure they have some at current prices. But they're not going full in yet that Brazil's not going to have soybeans. And we've certainly seen that the last couple of years. It seems like a repeated thing that every year there's a weather scare in South America, prices are going up. And yet the Brazilian crop seems to come in a little bit stronger at the end of the day than what we expect. So we'll have to see if that's the case this year. Local bids in South America would suggest that they are having significant troubles with soybean production.
So I want to keep the conversation on global issues and export implications. So looking at wheat now, it's been a roller coaster on the wheat futures last several days. Sharp climbs up and then some profit taking that we've seen recently. So give me a kind of an update on what you see the potential for U.S. wheat exports with Russia and Ukrainian issues.
Yeah, so we've been watching this scenario in terms of what's going to play out in Russia and Ukraine, and I truly believe there's only maybe one person that can answer that question. And even then, I'm not sure when the timing of what's going to happen with the Russian aggression towards Ukraine. That's certainly built up a lot of speculation within the wheat markets. Last week, we saw managed money funds increase their long position significantly in wheat contracts, up almost 17,000 contracts in wheat. Now we expect most of those, I anticipate most of those were sold off at the start of this week as funds took their profits and left that complex on kind of some softening tensions there. But certainly, the wheat contracts have seen some nice rallies as the aggression has grown, and as we've heard other news from either the U.S. or Great Britain about actions that they plan to take. But seems to be a little softening in the wheat market as some of that is starting to kind of work out of the system.
So kind of relating that to corn, is there any correlation there? What are you watching with corn when it comes to those tensions too?
For corn, it's really all about just global grain shipments. This is the time of the year where corn shipments pick up. We need corn shipments to pick up. They came in not bad, but not great last week. USDA inspected about 41 million bushels of corn, which was down from the 47 million bushels the week prior, and a 4-week average of 41 million bushels. That's not great to see the rolling average, to see the average come in below the rolling average. It is promising to see who was taking shipments on the week. The top 4 countries in order were Mexico at 33%, Japan at 24%, China at 19%, and Colombia at 13.6%. Those are pretty traditional buyers, and so it's nice to see those buyers in the picture. At 19% for China, that is a little softer than what I'd like to see given the amount of corn that they have on the books for U.S. grain. When we look in total, grain shipped for corn continues to fall below USDA's target, or the needed pace to hit USDA's target. So we have to see some increased shipments if we're going to maintain our current export target for corn.
Looking domestically, what kind of factors are supporting or maybe causing some issues within the market either way?
Well, ethanol's been the shining star, and really domestic consumption, both for corn and soybeans, has been the shining star this year. Ethanol or exports have been disappointing, mostly for most crops, whereas domestic production has been strong. And to your question about ethanol, we are coming off a 2-week slide in production. This last week, it was just 1.035 million barrels per day last week. That's estimated to use about 1.3 million bushels of corn. I look at this and say, I'm not surprised that we've been sliding back down a little bit, because we were producing at such a high level that it was hard. I felt like it was going to be hard for us to maintain that pace for a long period of time, as we needed to do some maintenance and some other things for these facilities. And as winter weather causes some strain on the supply chain, grain, we haven't had any major winter weather in most of the region for 2022 so far, but we'll see. The U.S. grains crushing report is going to come out today, and that's going to give us a better estimate on how much we've been crushing and the ratios of corn within that ethanol margin. But we continue to sit about 9.5% above the same period last year, with USDA only estimating a 5.9% year-over-year increase in corn crushed for ethanol. So that's positive. That we've continued to see positive developments in that. A concern I have is, while we saw production fall last week, and it was again down 2 weeks in a row, the concern for me is that ethanol stocks also grew on the week. Ethanol stocks grew 37 million bushels last week. Again, maybe not as much driving out there, maybe not as much exports on the week as what we'd like to see. This continues to put downward pressure on ethanol prices, which fell below $2 for the first time since April of 2021. So again, we were at very high levels for ethanol prices, and we've been sliding down. That, coupled with higher corn prices, has shrunk the margin for ethanol producers. However, they remain positive. And as I look ahead, oil prices continue to climb. They're above $86 a barrel, which again helps with the competitiveness of ethanol and blend margins. And so, we're going to continue to see what I call strong production levels of weekly ethanol for the next couple of weeks, but the incentive to produce at those levels is falling.
All right. Well, appreciate the conversation this morning. Reports to watch this coming week, like you said, Ben, the grain crush that's later out this afternoon. Ethanol report that's on Wednesday, and then export sales report that comes out Thursday from USDA. Ben, it's always a pleasure to have you. This has been the weekly commodity market update. I'm your host, Will Robinson.